Risks to achieving our employment and inflation goals have moved toward better balance.
Inflation eases, but the Federal Reserve sees just one rate cut this year. I'm Lisa Bernhard with Reuters, and joining me today is Eric Diton of the Wealth Alliance. Okay, Eric, this was a big day for the U.S. economy. We had the CPI inflation numbers this morning, which showed that prices remained the same in May, and the inflation rate decreased a bit annually. And right now, we have the Federal Reserve concluding its two-day policy meeting, and it sees just one rate cut this year, despite acknowledging the progress on inflation. How surprised were you? What's your takeaway from this?
First of all, I'm very happy today. I just think that we've had an overheated CPI for a bunch of months, and it was nice to see what I'd call a benign CPI, and the markets responded accordingly. Stocks up big, bonds up big. That's all good. In terms of the Fed policy, I don't think there's a surprise. We knew three rate cuts is out. It's out. It's gone. The economy's been too strong. And I think one rate cut makes sense. If the markets were upset about one rate cut, we'd be selling off, and we're rallying big. So I think the market is happy. There are a lot of people that were suddenly saying no rate cuts. So they'll take the one.
We still are a ways from the Fed's target of 2% annual inflation. What's the sticky part? What are the prices that are not coming down that have been preventing us from getting to that number and keeping us in that 3% range?
Yeah, I think the biggest issue, remember, with CPI, roughly a third of the index is rent or owner's equivalent rent, what it would cost to rent your house. Housing has been stubborn. Remember, interest rates are high. There's a lot of people out there, they don't want to sell their house because then they got to get a new mortgage and the rates are going to be a lot higher. So people are stuck in their house. And for these millennials and Gen Zers are looking to buy, there's not a lot of supply. And that's affording landlords to increase rents at a faster rate. And that's a big challenge. That's a third of the index. What helped this month, gasoline prices came down. I think food has eased a bit. Another issue has been services. We all came out of the pandemic and we want to do stuff. We want to travel. We want to go out to rest. We couldn't go to restaurants. We want to go to restaurants again. And all those services that were suffering for a long time, well, they're trying to make up for those lost revenues, and they're increasing prices too. So those are the issues.
The labor market, as we know, is still strong, as we saw in last week's jobs report. So give us an update now on the strength of the consumer.
Yeah, the consumer is solid. We had 272,000 new jobs. That was much higher than expected. You know, everyone talks about higher rates. Oh my God, it's terrible. But remember, higher rates bring higher interest income. And $3.7 trillion has been earned in interest and dividends in the first quarter of 2024. That number 4 years ago was 770 billion. 770 billion to 3.7 trillion. That's a lot of money to spend, a lot of money in people's pockets. Don't forget, we've got Infrastructure Act, the CHIP Act. There's a lot of fiscal stimulus that's been going into the economy. So even though monetary policy is tightening, fiscal policy is not.
We are seeing stocks continue to climb. We had two record highs this week for both the S&P and the NASDAQ. Are we still seeing those large mega cap companies driving the market? And if so, how concerned are you about that?
You know, Lisa, I just saw a statistic. It's pretty astounding. The equally weighted S&P is the same price that it was 2.5 years ago. So we're all saying, oh my God, the market's flying. If you didn't have the market cap weighted stocks, those biggest stocks, those huge tech stocks moving, the broad market hasn't even done that much. So let's be clear. 3 stocks are now 20% of the S&P. Has that ever happened? No. That is as lopsided as we've been. And we know who they are. We know the offenders, Microsoft, NVIDIA, Apple. This is very much a two-tiered market. It's a narrow market, advanced declines going the wrong way. new highs, new lows, going the wrong way. I don't even want to talk to you about small cap stocks. Minus 4% a year last 3 years. So it's these big tech stocks that are carrying the day. How high do they go? No one knows. We're early in the game, but let's be clear. NVIDIA is trading at 74 times trailing earnings, a lower future PE, granted, but still 74 times. Microsoft 38 times, Apple 34 times. These are companies valued around $3 trillion. They're huge. How fast can they grow for how long? You know, I was around in March of 2000 when Cisco was worth $550 billion. And everyone talked about how it was going to grow forever. And here we are 24 years later, and it's 184 billion, down from 550. Things change in technology.
I want to point out a stat that you noted in your notes, which is that 72% of the largest stocks globally are foreign stocks, not shares of US-owned companies. What was the catalyst for that? And my guess is that you would be recommending to Americans that they should have exposure to some of these companies.
Yes, there are long cycles between the US outperforming and underperforming international. Some of that has to do with the currency. When the dollar is strong, and it has been very strong, that is a headwind in owning foreign stocks. But the bottom line is we've had a tremendously long period of the US outperforming. Our valuations are considerably higher than international. And what's going on? Well, the ECB just cut rates. We're praying, we're waiting for the Fed to cut rates. ECB just did it. Switzerland did it before that. So did Sweden. So they're already starting an easing cycle. They're priced a lot lower than we are. By the way, Europe's made a new high as well. So there's some momentum there. Earnings are looking pretty good there. And we can get cheaper stocks, higher dividends. No one here's interested. Everyone is obsessed with AI. But if you're a Warren Buffett guy, if you're a Benjamin Graham guy, and you're looking for value, you got to start looking overseas. There's some real value there.